So Shopify, you can already tell I have a bias against it. Every investment is the present value of all future cash flow. I'm hoping that it become a much more profitable business as time goes on. Shopify stock, let's take a look at it. First off, the love of my life, Cathie Wood. It's her 9th largest holding right here. It's 5.5% of her portfolio. Guys, this is my view on Cathie Wood and Jim Cramer. Remember in the movie, The Big Short, when Steve Carell's character has sushi with the one guy, he stands up and ends up saying, short everything that guy touches. Short everything that Cathie Wood and Jim Cramer touch. Cathie Wood has no understanding of business, has no understanding of investing. She is very dumb. Who's dumber, Jim Cramer or Cathie Wood?
It has to be Cathie Wood.
Do you think so?
Yeah, because Jim Cramer is smart enough to get himself on CNBC and continue to keep his job in some way and maintain a pretty good audience. And she just doesn't have that and loses money.
Okay, so Shopify, you can already tell I have a bias against it. We're going to take a look at it and we're going to run it through our stock analyzer tool to see what it's worth to us. So let's check it out. If you think I'm blunt and you're new to the channel, I apologize. Maybe turn off the video. I have no idea. So,
do you apologize?
I don't apologize.
I think so.
All-time high, 176 back in November of 2021. The stock is currently at $45 a share. 52-week low, 23.67 just back in October. So it's up quite a bit from its all-time, from a 52-week low. Market cap, 61 billion. Oh, look at this. Enterprise value, 58. Guys, when this is negative, it means they have very little debt and more cash that can pay off all of their debt. That's pretty awesome. That's a check mark right there for Shopify. So they were managing their balance sheet very well. Now, here's their problem. Negative 61% profit margin. Last 5 years is negative 2%. Net income, negative 3.46 billion. Average 5-year cash flow, 125 million. Free cash flow, last year, loss. $61 billion company selling for 10, 11 times sales. Now, as an example, I threw a lot at you right there. Price to sales is a great thing to look at when you want to compare a company that isn't making money to what other companies are doing. What are you going to say,
in
Mo?
the space?
Don't look at that. Look at the gross margin here, 49%. Okay. Who has a better gross margin? Microsoft, 68%. So almost 20% more, 22,000 bips more, right? Price to sales ratio on Shopify is 11, and Microsoft is 11 as well, 10.65. Now, does Shopify have more growth potential than Microsoft? Absolutely.
Definitely.
But Microsoft also has more gross margin.
Right.
But Shopify has more growth potential. So just because a company is losing money doesn't mean you can't value it. Because remember, every investment is the present value of all future cash flow, right? When they have net losses along the way, but you're getting big payouts in the end, that's part of the future cash flow. So it can still make sense. But the question is, what is the right price? So let's go check out some things on the income statement. All right. Big growth.
Yeah, big growth.
10 years ago, they did 100 million in revenue, then 200, then 390, 670, a billion, billion six. COVID happened, 3. So they took COVID, they took their business to another level, and they sustained and kept growing from there.
That's the amazing part.
That is the great part.
Yeah.
Now, the interesting part is this. Let's look at the net income. There's only 2 years of profit.
Yeah.
So a lot of investors might have thought, now let's see if there's a write-off in this. That's a really big loss, Mo. So guys, what I'm sitting here looking at is whenever there's a big jump in loss, I always think to myself, maybe they wrote something off. It'd be in other income and expenses. It's not there. They just did not like making money. Oh, wow. Look at their operating income by year. Negative 20, negative 18, negative 37, negative 49, 92, negative 92, negative 141, 90 to the positive, 270 to the positive. Big loss. Big loss. Man, oh man. Oh, here's other income. Nope, they did have other income expenses. There it is. Negative $2.9 billion. Previous year, they had a positive $2.9 billion. So these offset each other.
They just canceled each other out. Yeah.
They just cancel each other out. All right. So it's like, okay, understand what that is, because that's a very big difference from previous years. Look at these years and then 135, negative 3 million. I mean, just very big fluke. You got to understand what that's for. Okay. Let's go check out the.
As far as shares outstanding go,
yep.
They're diluting it. There's no doubt about that, but it's not as bad as I would have expected.
What are they diluting? How much?
So in 2018 and 2017, they had 1 billion shares outstanding. Now they have 1.27. Wouldn't you expect more from a company like them?
Yeah, you're right, Mo. With such an overpriced company, you would have thought, well, they did, Mo. Look at this. Actually, they did do this back when it was massively overpriced.
Oh yeah, they did it.
Well, no, 2021 was their biggest year.
Yeah.
Yeah, you might be right. That's crazy. All right. Let's go see the 8 pillars right now. So, a lot of red. Now, they do have revenue growth. Guys, this is a hard company to analyze. And the reason being is it's in the startup stages, basically still startup stages. I can't imagine I'm saying that for a $5.6 billion revenue business. But the question is, what's it going to take for them to be able to generate profit? Consistent profit and growing profit. With a 50% gross margin, that means for every extra dollar they sell, they put 50 cents basically to the bottom line before taxes. That's incredible. That means if they double their business from 5.6 billion to 11 billion, they've added 2.5 billion to the bottom line. That's a big number. And that takes them sizably to the bottom. Now, but let's look at it this way. Let's say they did that before taxes. That only takes them like, what? $2 billion in profit, and they're $61 billion. It's still a 30 PE. Yeah. That's the hard part. When people see a stock going up and with losses, they sit there and tell these stories. Oh yeah, they're losing money now, but imagine the future. Because everybody remembers Tesla, which we think, by the way, is still a massively overpriced company. And I do believe you got to look at who owns this company to understand, is it a value or not? And the fact that Cathie Wood, it's her 9th largest holding, that makes me just go, oh God, she's so dumb. No way. No way. I look at all of her holdings. I'm like, I don't like any of her holdings. Literally. Not a single one of her holdings do I like.
You still have that list pulled up?
No, but we did a video. Why? What do you want to know?
I just want to see what they were.
Oh, it's Roku, Tesla, all these things. They're massively overpriced.
Are you talking about the video we did like 2 years ago?
The video we did 2 years ago.
Yeah. 17 out of 20 did not make money.
Her top 20 holdings, 3 made money. 17 did not make money.
Yeah.
We put it in our 8-pillar portfolio here. It was terrible. Absolutely terrible. Now, guys, let's look at the analyst estimates. Now, analysts are expecting Shopify to make 3 cents a share this year. Okay.
Oh, yeah.
Getting up to $1 per share. Now, let's say in 4 or 5 years it gets to $1 a share and you're willing to pay 20 times for that. It's $20, $21 a share. Call it high side. No, 22. Sorry. What's it at right now?
44, 45.
Okay, pay $30, 30 times profit. Still not there. You're paying 45 times or 40 times the profit from 4 years from now if the analysts are right. If these 3 analysts are right, is that worth it to you? Let's look at their revenue growth assumptions.
Pretty big.
High revenue growth, 20% a year. 20% a year. That is awesome. But again, they're barely converting that to the bottom line. Right. $1 per share. If you're okay paying 40 times 5 years from now's profit, more power to you. More power to you. But at some point, you've got to take every investment and realize your return is based on the present value of all those future cash flows.
If you do that, if you do this type of investment over and over and over, it's probably not going to work out very well for you.
Correct.
Some will hit. Maybe one will hit, but a lot of them won't.
Correct. Now, what we're going to do now is a stock analyzer tool. Now, guys, if you've liked everything you've seen so far, this software, everythingmoney.com, comes with all these tools I have listed here, everything you saw, plus the community of thousands of investors. Check it out, $7 for 7 days on everythingmoney.com. It's a promotion. We have the price is going up very soon to $39 a month. So and even then, it's only $1.30 a day to change the way you look at investing. This will pay for itself many, many times over. So guys, we're going to do a little stock analysis. Mo's going to do a 10-year analysis on our stock analyzer tool. I'm going to do a 20-year. The reason being is I want to sit there and project out profit for a long time. Now, here's the problem with stock analyzer tool with Shopify. We're going to assume profit day one.
Yeah.
Shopify has to start making money today. But guess what? The analysts believe they're going to make money this year.
That's true.
But it's going to assume that profit margin over the next 20 years.
Yeah.
So I'm going to have a very wide range because I'm going to start with a very low profit margin and do a very high one. Mo's going to do the same thing, but he's going to do a 10-year analysis. I'm going to do a 20-year. Please hang on for a second. We'll be right back. All right, guys, so we just put our information in. Mo, let's start with you on a 10-year analysis. What are you assuming for revenue growth in the next 10 years?
So I did 15, 20, and 25.
Okay. I think that's very reasonable. That's a lot, though, on the high side.
It is.
I did 7, 12, and 17. Might seem a little low, but remember, a lot can happen in this time period.
Yeah.
Profit margin, what'd you do?
I did 10, 20, and 30.
I did 5, 13, and 21.
Okay.
And the reason being is this still assumes you have to have profit day one at 5%, and they're not going to have that.
Correct.
And 21 still assumes 21% profit today, and they're not having that at all. That's $1 billion in profit today.
Yeah, it's not going to happen.
Same with free cash flow?
I did the same thing.
Okay, what'd you do for PE?
18, 20, and 22.
I did 14, 15, and 16 for both because of the uncertainty.
Yep.
The uncertainty, right? And same with desired return. What'd you do?
I did 14, 16, 18.
Wow, I did 12, 14, 16.
My numbers were also way higher.
That's true. So guys, remember here, before we show you our values, Mo made higher assumptions, so he put higher desired return. I made lower assumptions. I did a lower desired return. But remember, this is still high for the company based on what we're seeing today. I'm hoping that it become a much more profitable business as time goes on. This isn't terribly high, but again, it assumes this number today. I just want to show you this to show you how overpriced Shopify is. I have a low price of 4, and even in my highest assumptions, I have a high price of 38, middle price of 15. Mo, what do you got?
I have 13, 35, and 70.
Okay. So Mo has...
If you believe these but again, profit day one.
That's the hard part about this.
If you believe these numbers, then yeah, you're there.
So guys, what I want you to do is subscribe to the software because there are very few companies like this that are losing money. This is better for companies that are stable or have profit and some sort of growth potential with it. So thank you very much for watching this video. Again, remember, be careful when you invest your money because these things don't work out as often as you want them to, but we hope they do for you. Thank you very much for your time.